Hello and welcome to a brand new show of Market Makers. We are back after a break, and on this edition of Market Makers, we would be discussing not only India-centric cues, we would also talk about risk, global positioning, and if there is decline in crude, why is there a strong uptick which is there in iron ore? If private banks are consolidating, why are PSU banks outperforming? Risk versus reward, how exactly is the equation stacked up? So all that and much more with the Sandeep Tandon of Quant Capital. Sandeep, fantastic to have you back and thank you for joining us. I have your latest strategy report in my hand and you are making a case for a sizable correction which could happen in this quarter.
Yeah.
Why is that?
Okay. See, our call is clearly linked with the global risk which is changing. And post-Trump, if you have to look at the risk appetite, which what we call it Quant known risk index, that has moved up very sharply. In last 6-7 months is a vertical move. And whenever we have seen a vertical move in last 20, 25, 30 years data which we have built, it's a clear indication risk appetite is speaking out. Though market has not corrected, walls are significantly low, none of the data points are showcasing. But if I look at the pure liquidity data and risk data, these two data are very disturbing. Risk appetite not only in US but even now in Europe and other developed market also speaking out, and worrying some is that liquidity has started declining. Okay, declining
Why do you
liquidity.
Say that? Let's spend some time understanding which way liquidity is going to move, because markets are obsessed with liquidity in an unhealthy way, but yes, they continue to remain obsessed with liquidity.
So we are not looking at India or Asia liquidity. When we look at, let's talk about global market first. Okay, so global liquidity is declining. And obviously, global market US has 60-65% weightage. So if US liquidity decline, it has a impact on overall liquidity. Where within developed market, Europe liquidity has started rising. Japan is inching up. So there's a healthy position out there, and particularly in Asia, all Asia-centric emerging market, including Japan, is in a very healthy situation. The real impact of liquidity decline you will see with a lag effect. It will not happen on immediate basis. Okay, where risk appetite sharp fall can be reflected, maybe in 2 weeks time, 3 weeks time, or maybe sometimes few days also. Liquidity is a very slow thing. Like liquidity was pouring into India, and then you saw stock market started rallying despite post remonetization. People were worried about India. So our concern is on declining risk appetite. Rather, risk appetite has peaked out and liquidity has started declining. Our data on liquidity cycle is also indicating that liquidity will either has peaked out in the end of June or somewhere very close. So in next 10-15 days, we believe liquidity cycle is peaking out, risk cycle is peaking out, and third important factor is valuation. The valuations are also expensive. We remain very constructive from a longer term perspective, but in the beginning of the year, we were concerned about Q3. We think Q3 will be the worst quarter for 2017 globally, more from a global perspective, less from India perspective. But if global market corrects, India is very naturally will also correct.
That's a very tall statement when you said that we expect Q3 to be the worst quarter in a long time. So do you expect global markets in this quarter, which started on 1st of July, in this quarter can global markets correct by 5 to 7%?
Even it could be more also. Okay.
As of now, global markets to correct more than 5% in the next 3 months?
Yeah, it can happen. See, I'll again reiterate from the risk point. Like post 2008-9, the risk appetite index or Quant known risk appetite for US market collapsed. It was one of the decade's lowest point. And right now, we have one of the decade's highest point in US market. So very clear indication, when you from the extreme low to extreme high, it moves very sharply. It's a clear signs of a potential reversal. Now, none of the data points, if you look at from risk appetite, it's showcasing, but if you sit down and analyze, look at the geopolitical stress which is there. Gold moves up and corrects. So when Korea related geopolitical at its peak, gold actually correct, crude corrects. Okay, any negative news has come on the geopolitical thing, these asset class instead of spiking has corrected. It clearly indicates something has changed. So-called standard correlations are not working. Okay, and currency data point is showing signs of disturbance, particularly look at the DXY. We also made a tall statement in the beginning of the year that DXY 2017 will remember as a DXY top, but we also thought it will go to 107, 108, but it has peaked out at 104. All the data points is now indicating the dollar index on the verge of crack. Okay, if dollar corrects to closer to 90-91, which it looks like, then euro will start appreciating. And whenever we see a change or sharp reaction in the currency market, okay, or the bond market, the reaction in the equity markets will be knee-jerk, and you will see market correcting sharply before market really understanding what exactly happened, but there will be knee-jerk reaction. So let dollar index break 96, let's gold break these levels, so 1218 or 1200 levels. Then you see some amount of panic getting built, these asset classes are not respecting, and then what we call it is a classic sign of risk off environment coming back.
But where will money move? If money moves out of the dollar index, if it moves out of global equities, it cannot go back into bond markets because we are in a rising interest rate regime. Historically, every time when we've seen a risk-off moment in the world in the last 5 or 8 years, the natural shelter markets have taken is under the banner called US Treasury.
Yeah.
That is not a profitable trade right now. So even if there is a scare or a liquidity, risk-off moment, money eventually will come back.
Correct. So I'll answer that. So look at when bond market peaked out somewhere last year in July 2017-18. 2016 bond market peaked out July, August. From there bond market in 3 months time they corrected nearly 30%. Bond future, 30-year bond future corrected actually 33.3 to be precise number. And from then you see a very sharp liquidation which happened in the bond market, money shifted towards equity. Okay, and that's the reason you have seen right from July, August, global market has rallied sharply. So that's an easy phase, what I call it, the first reaction of bond to equity. That cycle has played out reasonably well. Now we are not advocating that bond market will attract money in the risk of environment. My point is that yes, bond money is shifting from globally from bonds to equity, but the key question is shifting more from US. It is shifting towards Europe. That's the biggest liquidity which is moving towards Europe. Second largest liquidity is coming to Asia, including China, though China's market has not performed. China is attracting good amount of liquidity, Japanese market is attracting. So anywhere where liquidity is coming, those are the relatively, I'm using the word relatively safe havens. But if US corrects, okay, then I think it's the mother of all exchanges. Every market has sentiments linked. You will also see maybe they correct 8%, we might correct 4%, they correct 15%, we might correct 7-8%.
You know, I'm with you when you said that US markets are just about getting slightly tired. The rally is concentrated, volatility is at an all-time low, markets are just obsessed with liquidity in a very unhealthy manner. And if I frankly look at the NASDAQ composition, FANG stocks, only 4 or 5 stocks are the ones which are really leading the market cap surge, and Apple also has started reversing. So for me, the leadership in the market is changing. But let's talk about India.
Yes, let's spend 2 minutes more on US because that's the critical. Our big call is that 2017 will remember as a long-term top for US market. I am using the word long-term. In our report, we have written 2017 will remember as this decade top for US. Okay, and that's a not only bold statement; it comes with a high conviction. Okay, when we look at market from 3-dimension perspective, that what you call trilogy: liquidity, risk, and valuation. On all 3 parameters, US market is like some sort of bubble which is there. Okay, as you rightly said, limited breadth. If you look at the breadth indicator, US NASDAQ breadth has peaked out maybe a month back. Dow Jones breadth has peaked out maybe few months back. Okay, so breadth has peaked out. Everything is not participating because certain heavyweights are started participating. The market is making a new highs. Okay, but the internal analysis of the market, if you analyze on all 3 parameters, is giving you signs of disturbance. Okay, what would lead could be geopolitical, it could be Trump-related volatility, and that is the worry point. I think the problem will start from US. Problem will not start from emerging market.
Okay, so what happens to India? I mean, average investors currently are spoiled because of this rally in mid-cap stocks. The demand to buy into mid-cap stocks is slightly insatiable. The general view is that there is a lot of domestic money which is coming via the SIP route, and you don't have to worry about mid-cap stocks because fund managers will take care of that.
So I'll just take one step backward. Let's look at post-remonetization. I want to spend 2 minutes on that. 99% strategists in this country has given up. People deferred, downgraded India for 2 quarters. Some people downgraded India for 2 years perspective. We were the one house who talked about 20 to 25% return coming, okay, because fear index was at 3rd largest level, short position was high. Now market has rallied more than 30%. Okay, so that was the call. We say the first quarter will be the powerful. Our Q2 from a calendar year perspective, we still be equal weight, and Q3 will be underweight, and Q4 again will be overweight. Now, if you look at from Q2 perspective, so we said that from mid-May to Q2, risk of environment will start, and it will have this peak at Q3. Look at in last 1.5 months time, mid caps has actually just given a negative returns of 2%, where FMCG index has given a positive return of 16%. Okay, so a clear indication of risk of environment is there. Mid caps has not done much. It has given negative return. Nifty, Bank Nifty hardly 1.5 to 2%. So sector rotation obviously is, but money is moving towards defensive name. Money is off late moving towards pharma name. And the most important question which you raised about retail participation, so retail exactly come at the peak of the cycle, and which is reflected in the small caps. The small caps is the biggest outperformer,
so
not the mid cap.
Are you making a case that one should sell Indian stocks lock, stock and barrel?
No, we are not making.
You're sounding very bearish.
Okay,
I've never heard you that bearish in a long time.
No, we are equally bullish. I am extremely cautious on Q3, extremely cautious on global perspective.
So you expect that whatever stock you want to buy, don't buy right now. As the quarter unwinds, you will get
Q3 will give you phenomenal opportunity to rebuild your exposure for next 2-3 years perspective.
So wait for a 10% decline, 15% decline in mid caps?
It's very difficult to say 10-15%, 10-15% mid cap correction we have already seen in many stocks. Okay.
What are you telling your clients to buy right now?
So defensive names. So I like to increase my exposure towards more towards FMCG, more towards pharma, maybe from a trading perspective IT for this quarter, not from a long-term perspective given the weakness, because with this risk of environment we expect rupee also to be depreciate, not very significant. We were the big bull on rupee appreciation. We talked about 58 levels when it was 69. Okay, it came closer to 63, 80 levels, which was our this year range. But we expect in next one quarter rupee can also depreciate closer to a rupee or so.
So what are your top 3 ideas at the current levels, and what are your top 3 ideas on a 10% decline?
So from a decline perspective, I think the same theme of banks and financials. So I will be a biggest buyer on some of these NBFC company, private sector banks. But right now I expect there could be correction in these names also. So financial remains a top pick in the correction. Mid caps also remains, small caps also remains a preferred destination when it correction happens. From the immediate basis, well, I like to more on defensive side. So FMCG will play a role, pharma will play a role. These are top 2 picks.
Are you advising that one should buy these richly priced consumer staple stocks just because markets are going to correct? Because if you frankly ask me, the risk what I see in this market is a valuation risk for the consumer staple names, Nestle, HUL, Colgate, even for that matter, you know, a company like Britannia, the pre-multiples are now north of 40-50 times.
So you also have to look at, they have underperformed for last 3 years. Okay. And domestic mutual fund is getting enough money. Where money will go? Money will go towards, so under owner. So I agree they are not cheap, but they are not that expensive that they used to be, and they are one of the biggest beneficiary of GST also. So when we are not saying that they are significantly under-owned. I think we have reached a stage and relatively they are under-owned. So it's all about relative things which is happening. Okay, so relative under ownership is driving these prices, and despite all Patanjali noise and everything which has happened, look at the Colgate has moved up, Lever has moved up. It's giving you a sense money is very smartly shifting toward this sector.
So at the current levels, you are happy to buy into FMCG, but just for a trade?
I will not say for trade, maybe for a slightly long-term perspective also.
So which are the 3
and
FMCG
this is when we
names you like?
Premature to make a big call right now, and we have to see how it shapes up post this GST phenomena, how they are.
So which are the 3 FMCG names you like?
So ITC number 1 pick, maybe could be Lever, and then followed by, depending on Dabur we like.
What is your understanding of ITC? I mean, how will it benefit because of the new regime? The market cap of ITC now is north of 4 lakh crore. That makes ITC one of the most valuable companies in India. I mean, there are only 4 companies which are part of that 4 lakh crore club.
See, one key thing, the risk which ITC always has every time closer to budget, state government, central government will increase the, I think that risk is over. Okay, the GST coming into picture and cigarette being part of that is a clear indication that risk which every time closer to budget we expect state government or central government will increase. I think that will lead to a major P expansion of this thing. Okay. Second thing, if you notice, very interesting is that every time government has, people have worried, supply one Larsen will come, ITC will come from the government side or Axis Bank, okay, which has not happened so far. Okay. And people used to, this was one overhang was there, at some point in government will unwind these things. I think that last 3 years Modi government has not demonstrated. I think that fear is also subsiding. And third most important thing is relatively, I am again using the word, ITC and FMCG is relatively underowned in the current level of move which we have seen in the market. So it makes sense to be there in these names. Okay, when maybe risk on environment is back, maybe I'll prune down FMCG a bit and move towards financial and move towards auto, move towards high beta names. But when we expect risk of environment is knocking our door, I like to be more safe.
Are you advising your clients to sell or to go short?
No, we are not advising short at these level, because there is no signs of a classic top or euphoria which we are seeing. So we are not very in a camp of advising short. We are saying is that you have to shift your exposure, you have to rotate your holdings. That is some tactful, more of a tactful and active way of managing things, rather than saying we are not very bearish on equities.
Anything from the new IPO space which has caught your attention, anything which is worth buying? Because frankly, if you ask me, the definition of froth is there in the IPO market. Look at CDSL subscription and look at what's happened to Avenue Supermart or DMart after listing.
But I think that froth is also reached its peak. Okay, some of the recent IPO, you know, the pharma which we came, you know, we have it open below price, okay, below issue price, is a clear indication that cycle is also peaked out. Okay, and same thing, like I always say, 2016-17, what it was all about positive. Anything which is underowned has positive trigger, has delivered returns. These were under-owned stock, completely 10% float or 25% float, and it was easy to pull up because any small buying will take the prices to the next level. That I think that cycle is also peaking out. I am not saying from a longer term perspective, from a near term perspective, I think is a clear indication.
Even though IT and pharma are underperforming in terms of ownership, the ownership levels are still very high. Sun Pharma has a presence in 35 AMCs in India. There are only 42 AMCs in India. Infosys has a presence in 37 AMCs in India out of those 42 AMCs. So pharma and IT may be underperforming sectors, but fund managers are not reducing their exposure there.
So I completely buy with your argument, but key thing is that IT as a sector, I think structural damage has happened. So I'm not very bullish on the large cap. So in the environment when I'm saying risk of currency will appreciate or depreciate a bit, so I will like to trade for maybe 3 months perspective, 4 months perspective. Where pharma is concerned, structurally we are more positive. I think good amount of damage or correction which has happened is already happened.
Would you buy Sun Pharma at these levels?
Not Sun Pharma, but I also want to bring also one specific thing. Last year, if you look at even 2015, actually not even 16, global market peaked out. Pharma, we have seen outflow happening from May 2015 itself. With a lag effect, and I'm talking about US market particularly, with lag effect, 6 to 8 months we saw outflow happening in India. Last 3 months, US, we have seen huge inflow coming to pharma, and we are seeing outflow in the banking space. So health sector, what they call it, okay, is money is getting attracted and people are shifting from financial to healthcare. So that's a trend which is clearly visible, and I think it's a global trend.
So what would you like to buy in pharma?
So our top pick will be Aurobindo, followed by Cadila.
Why do you like Aurobindo?
Okay. Both Aurobindo and Cadila are more from a pipeline perspective. And look at the noise level which was there in the sector. Aurobindo was not impacted, not even one plant is impacted. Okay, which speaks about, and from a credibility perspective, people still don't believe Aurobindo's management. Okay,
but
and
the challenge for Aurobindo is that they have a debt. And pharma companies in India, with the exception of Aurobindo Pharma and Glenmark, none of the pharma companies have debt because they generate a lot of cash flow. If Aurobindo earnings are so strong, if pipeline is so strong, why is the promoter not consciously reducing the debt?
So I think you also have to look at, they are also growing. So it's lot of debt is linked there. They have acquired a couple of acquisition they have done. Okay, see this sort of significant debt which was there, it will take its own sweet time. My sense is that in next 2 years time, this company has potential to become a debt free, assuming that they don't go for any fresh acquisition.
What is your 3-year price target for Aurobindo?
If you look at any conservative manner, I think Aurobindo will give you the best return in pharma, and it could be a biggest outperformer in pharma, in Nifty also from a 3 years perspective, not necessary from near term perspective. I think a 40-50% return is possible in 2 years' time in Aurobindo. It's
So
a very conservative number.
So far what we've discussed is the relative positioning. You expect markets to decline right now and one should buy cover.
Yeah.
But what about absolute positioning? Let's forget what will happen in this quarter. Let's talk about next 2 years, next 3 years. For someone who is a real long haul guy, what should be a 2-year or 3-year positioning?
So 2-year, 3-year perspective, we are extremely positive when India could be financials as a theme and cyclicals. So cyclicals and financial as a theme which I like to play with a clear perspective that from a near term there could be a correction.
What would you like to buy in financials?
So top private sector banks remains whether it's Kotak, whether it's IndusInd Bank, maybe ICICI Bank makes a lot of sense from the current levels. Okay, so banks, some select NBFC will perform very well. Then infrastructure, you are not seeing valuation very attractive, but I think apart from large and many construction space, EPC space, you will see opportunity. Okay, unfortunately, not very big names are there. Okay, and they have their all challenges related to balance sheet right now. But I think in next few months' time or maybe years' time, you will see some traction or visibility happening on that space also.
Is there an overarching mid-cap theme which you are riding now? Let me just give you an example here. In 2015, early part of 2015, you mentioned that you were bullish on mining stocks. You mentioned that you were bullish on agri stocks.
Yeah.
So anything in the mid-cap space which could be called as a sunrise theme or a theme which has potential to become a large market pocket?
See, at this level, we are not getting anything like this. Okay, I like to see, let's say we have been very bullish on agri. Okay, obviously agri has done extremely well. We like to see in Q3 what sort of correction these stocks will give you. If correction is not very meaningful, then it means the sector leadership continues. I like to rebuild my exposure, which I like to prune at this point of time because they are expensive. But if Q3 will be very important data point for us, maybe end September, end October, if like to see how price reaction is. That if reaction is not much, not very meaningful, okay, let's say I'm talking about private sector bank and we expect some correction happening. For whatever reason, Kotak is not corrected or ICICI Bank is not corrected, I like to significantly add my exposure in these names. So
you also like Tata Motors?
I like Tata Motors also.
You also like Mahindra and Mahindra?
Mahindra also, we have been bullish for quite some time, but it has actually performed only in last 1 month.
Why are you bullish on Tata Motors when great investors like Rakesh Jhunjhunwala have also given up hope on Tata Motors?
Okay, so 3-4 things we look at right from valuation. I think is attractive. The issues related to currency related challenges which they faced last year, I think management is addressing. That's a sense which we got from our analysts and we have also met them. And the third most important thing aspect is about the under ownership. It is getting under ownership. And one more data points I want to bring. If you notice in post this Cyrus Mistry and Ratan Tata, whatever episode played out, Tata Group, one stock they bought, that was Tata Motors. If there this sort of buyback which is coming, okay, nearly 12,000 crores Tata Sons will get. Tata Sons, we are hearing they are also raising money to increase their holding in the group companies. I think the first stock which Tata Group will consolidate will be Tata Motors. So if promoter is a buyer, okay, this you can't get a better indication, anything like that. Okay, and Tata Group has, whenever they get a chance, they have bought Tata Motors. Okay, so if you analyze the data, also give you a sense. So I'm not saying Tata Motors from next 1 or 2 months perspective. Okay, but if you have that 2 years, 3 years big picture perspective, I think Tata Motors should be give you where risk reward is very favorable. Okay, like maybe downside could be 20-30 bucks and upside could be 300 bucks. Okay, where Maruti, we have been very bullish from very long time. We used to talk about 5,000 when it was 800 rupees. At these levels, Maruti is market performer. It's not going to be outperformer anymore. So we are not bearish on Maruti, but I think that easy money, the easy bull run, that is over. Okay, so to getting extraordinary returns, like Escort, we were very bullish from 80 rupees, 120 rupees. We are still bullish at 650 also, but that easy phase is over. We remain positive on the tractor. Answer is yes, but Escorts can double from these levels. It will take time.
Okay, so just to summarize our today's interaction, you are of the view that in the short term one should not take liquidity for granted. A sharp bull market correction could haunt us anytime soon.
Led by global clues, not by India clues. So India, we are not worried. We don't see any negative surprise coming from India. It will be global surprise, which will have its own impact on India.
So protect your cash. Sit on some dry gunpowder, because this market, in your assessment, will give a good and a decent entry point in next 2 to 3 weeks.
Correct.
But when the market corrects, that time one should be putting money to work rather than running from the market fear?
You should. In fact, I'm waiting for opportunity to rebuild the exposure.
What if you don't get a correction in next 3 months?
So as I said, that Q3 will be very important too, if we don't get anything meaningful, okay, because this entire thesis is based on the global liquidity and the risk environment. If you ask me, probability wise it should work, because historically it has worked, so why it will not work this time, okay. If it doesn't work also, it gives you a strength, okay, and I don't think that you will miss out anything big right now, because valuations are not cheap. So it's not like that valuation keeps on rising in one way only.
So you expect either a strong time-wise correction which already has kicked in, and now you expect a price-wise correction, because at the current juncture, according to you, the entry points do not favor a very strong price run-up.
Yeah.
Okay. Sandeep, appreciate your time. Glad you could join us, and thank you for joining us. That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for tuning in, and thank you for watching the show.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.